Welcome to Zoom Out 101. Where are the big opportunities? And starting from the bullish news, inflation has been falling. And one of the consequences of that is higher real wages. And with higher real wages, there is an expectation for stronger demand because people have more available resources to spend. In addition to that, there's expectation for rate cuts because the Fed seems to have achieved the lower inflation, so maybe they will be able to reduce rates quicker than previously expected, and that causes higher valuations of stocks. And so, with a combination of these two effects, the stock market has been trending up. So with that, let's turn to the bearish side. And for the same reason that inflation has been falling, the real interest rates have been creeping up, and that causes weaker demand. So we have the same cause with two different consequences. One is higher demand because of higher real wages, and the second one is weaker demand because of higher real interest that causes people to save more and delay spending. And at the same time, bonds have become competitive with stocks. You can get nice real returns at very low risk. And so after a very healthy run up in stocks, bonds have become much more attractive. And in addition to the lower inflation, the higher interest rates have been causing troubles in the commercial real estate space. There have been more and more defaults as buildings become not profitable for the owners. They simply default and give them back to the banks, and those decide to sell them or more likely fire sell them. So basically that creates pressure on the prices of commercial real estate. And that could spread into a banking crisis because now the banks have to sell those properties at lower than what the previous owners owed them. So basically they're getting a haircut on their loans. In addition, home purchases are on hold because of higher mortgage rates, and that could cause a drop in home prices. And finally, there's a mass auto loan default and also repossession. So basically, people who bought cars during the COVID times owe much more on their cars than what the cars are worth today. And so some of them decide to just stop paying the loan, send back the keys, or the owners, the lenders, repossess those cars, and they offer them for sale at auctions. And so that puts downward price pressure on cars, and could also trigger a bank crisis because of the haircuts on the loans. And finally, there's this conference board leading indicator, and as you can see, the leading indicator has been deep in a recession territory for quite a few months now, and so that's another sign for trouble ahead. And what's interesting is that if you look at the bullish news and the bearish news, I would give it an 80% probability for the bears and 20% for the bulls. But because the bulls have been winning and the trend is up and the trend is very persistent, let's just give it 50-50. Let's say that there's 50% that the bull market is going to continue and 50% that is going to give way to a bear market. But if you look at the options premiums, you can see that they are at all-time lows. and they're kind of saying, "Don't worry. There's absolutely no worry in the market. There's no willingness to pay for protection. Basically, the market is giving the bearish scenario with a recession and a crash pretty much 0% probability." So that's kind of the big anomaly that I see, that the volatility is very low. Nobody is willing to pay for premium despite significant bearishness in the data, and the prices are at all-time lows. So this is a sign of complacency, and what could happen is that if markets correct, investors are not protected, and they would need to sell in a very big way. So I think that put options offer great value, especially if they're used with structures that reduce the risk of owning them. And with the auto repossessions at all-time high, I think car makers are great targets for such structures. And in addition, also commercial real estate and banks. So thank you for watching, and I'll see you next time.